So, yes, my name is Erin Swenlin, and I am from DecisionPoint.com. I have a bachelor's degree in mathematics from USC, fight on. I have a master's in information resource management from the Air Force of Institute of Technology. And actually, I would say over 30 years now studying the markets. I've been looking at the markets since I was in high school with my father. He taught me a lot about the market, and a lot of what I learned about chart patterns I learned from him. So yes, I am from DecisionPoint.com. I am the Vice President and Senior Technical Analyst there. And I've been a consultant for StockCharts.com. They don't do the Stock Charts TV, but I I have a blog on StockCharts.com. All right, how to identify powerful chart patterns for trading success. So we're going to talk about the recognition of the basic chart patterns that are out there. We'll look at the bullish ones. We're going to look at the bearish ones. We're going to talk about the signals and minimum targets that these chart patterns can give you. And then we're going to talk about how you can set stops using chart patterns, which is very helpful. So let's start off with talking about bullish chart patterns. And give me a moment, I need a drink of water. All right, bullish chart patterns. There's the ascending or symmetrical triangle. There is a bull flag, which is one that I very much like. It works out pretty well a lot of the times. We have the falling wedge, and that one's a really good one as well. We have the double and triple bottom, which are they work pretty much a lot of the time. I like them as well. Cup with handle, I find those interesting. They don't always work out, but I have to say not all these chart patterns work out, but they give you a really good sense of what could happen. And a lot of times it does happen. And then we have a V bottom, which is a really great pattern. Now, we'll talk about that in a little while. And then the reverse head and shoulders. So we'll talk about what everybody is probably familiar with is the head and shoulders. Then we're going to look at, for the bullish chart patterns, there are the reverse head and shoulders. Okay. So here's the first one that we're going to look at. This is the ascending triangle. And the way you can identify an ascending triangle is you have a flat top and rising bottoms. Now we're going to talk about wedges, and a lot of times people can get a little confused with the wedge and the triangle pattern. And we'll talk about symmetrical triangles as well. And those have a similar look. But the ascending triangle is a bullish pattern. It's got the flat top and a rising bottom. So what happens is price will get up to this level of resistance. Traders will get it up there, and then they'll bring it down, and bulls will manage to turn it back up before it goes down to test support. So a lot of times you'll want to look for patterns, maybe not just the pattern itself, but what you want to look for is when price does not go down to a support level all the way, because that's oftentimes a really good indicator that things are bullish and things could continue upwards. So back here, actually right here, you can see that we had price go up and then it came back down, but it did not go all the way down to support. And because that happened, one of the reasons is because the bulls got involved and they were able to make price turn back up. And so that gives you that that chance of a move upward that you can take advantage of. It also is helpful for setting stops, right? Because you'll have the price come down, almost come down to that support level. And what you can do is set your stops below that support level. And that will set you up in case the bear or the bulls don't win and the bears win out and the price goes down below that support level. So that's one of the areas you'll want to look for. So here we have that ascending triangle. You can see that price the bulls kept taking over control, and eventually the spring was uncoiled and we got the big breakout to the top. These are continuation patterns. Typically what you're going to do is this is going to show you a continuation of the current move. It's not a reversal pattern, so I should change this. It's when you get one of these patterns, the expectation is that you will get that breakout to the upside. All right. Make sure there's another pattern on this chart I can point out while we're talking about it. My eyes, you get used to when you start studying chart patterns, your eyes will get used to finding them when you're looking at charts. I can see a second pattern on this particular chart. We'll talk about it, but the double bottom, you can see this sort of W look, and that gives you the double bottom. This is also, you could maybe stretch this out into a cup with a handle. So there are lots of different patterns that are going on in this chart. This is the symmetrical triangle, and this is definitely a continuation pattern. These patterns will continue the move that was going on previously. So you've got price coming down into the pattern. The expectation is a breakdown from the pattern. These are, you have the rising bottoms and declining tops. Basically, they're going to come down into an apex. That's what you're looking at with the symmetrical triangle. So we talked about the ascending triangle. Remember, that was flat top, rising bottoms. Symmetrical triangles have the rising bottoms, declining top. Another drink of water, hold on. All right, so they are continuation patterns, so they can break in either direction. So the expectation is that they're going to continue the previous trend, but that's not always the case. They are typically about 3 weeks in duration, but I will tell you that with most chart patterns, really, in my opinion, all chart patterns, they can be in any time frame. You know, you can have a 10-minute chart and see a symmetrical triangle on a 10-minute chart, and it will oftentimes resolve the way you would expect it to. So I'm going to show you, and I'm giving you the textbook durations, but honestly, from my experience, I find with chart patterns, I can use them on any chart and they tend to work out. So just something to keep in mind. But the textbooks say it needs to be about 3 weeks in duration on your daily chart. We have the bull flags. These are great, great patterns. These patterns work out a lot of the time. And they are great because you can get targets out of them. So just like a flag, you have a flagpole, and then you have a flag on the flagpole. And typically what you're going to see and what you want to see are flags where the price is moving downward. So you want the flagpole to come up and then a period of declining trend. And that is one of the better setups. The other one would be a flagpole with a pennant on it, which is, this isn't quite a pennant, but it would be a symmetrical triangle basically on a flagpole. And both of these patterns, the expectation, of course, is a breakout. They are continuation patterns because they typically continue the previous trend. This particular one isn't really a continuation. It's kind of coming off of a decline, but it's continuing the flagpole. So that's why it's considered a continuation pattern, not a reversal pattern. These patterns are going to come in the middle of a move, and that's what you're looking for. The length of the flag can give you the targets of the patterns. So in this case, the flag was this tall. And so when you measure, if you go up the same amount, that gives you the target of the flag. And in this case, you had pretty much the textbook completion of the pattern. Up here, you got your upside target. It didn't quite make it to the upside target. It didn't quite make it to that upside target, but it was very, very close. And so that's what you're looking for with the flag. I love with the flag, though, that you can do these back of the napkin sort of measurements to determine where price is going to go after it. And you're going to find these pop up a lot on your charts. Just remember the height of the pattern added to the top of the pattern is going to give you the upside target of the pattern. And these are minimum upside targets. So a lot of times they'll hit the target and then they'll keep on going. And that's, perfectly normal because the target is a minimum target. How long do I have today, David? I can't remember. I think I have 40 minutes. Just want to make sure I get through all of them. All right, the descending wedge. The descending wedge, we have two declining trend lines.
Sorry, I set my mic down for a second, but you have until 1 p.m. Eastern, so the top of the hour.
Okay, full hour then. So
Yeah.
I'm all right, excellent. Well, we'll try and make this last. I think we have plenty of time to cover all this. We might have time to go and start searching for some patterns on stock charts. That would be kind of fun.
Yeah, if
All
you want to do
right.
some live analysis too, that'd be great.
Yes, you got it. So we've got the descending or falling wedge, and these are great patterns. They work out a lot of the time. They are considered reversal or continuation patterns. So you could get a continuation. This is not a continuation pattern. I'm not sure why no, I guess it is because we're continuing this prior move. Give me a minute. This morning, it's been crazy. So anyway, we have the breakout here from that falling wedge, and it's continued this particular move. Now it could come down into this pattern and then form the wedge, and then you get the breakout. So that's what I mean by a reversal or a continuation pattern. All right. They break to the upside, and then there's kind of a back of the napkin minimum upside target you can do on these. I don't have it written into the chart here that I have, but if you take the back of the pattern's height and add it to the height at the front of the pattern, that'll give you kind of a good minimum upside target to kind of look for. So in this case, we had a height about this tall. That would put us pretty much a little bit above this level over here, but that's just kind of like I said, a back of the napkin sort of calculation. There's the bullish double bottom. These are very easy to spot. They are W's, double bottoms, right? And these are reversal patterns. These, you can only have these be a reversal. You have to come down into that pattern. So if you see a W, like at the top of a pattern, that's not a double bottom. It's just not. When you get these, you're looking for a reversal. And these work out the same way as it does with the flags. You just measure the height of the pattern, add it to the top of the pattern, and that gives you your minimum upside target. So here is the confirmation line of the pattern. It runs across the middle of the W. So once price has gone through this line, you now have a confirmed pattern. So if you were watching this build, it's not technically a double bottom until you actually get the breakout above that confirmation line. So you can make think about what it could be doing when the setup is happening. But again, you don't expect the upside target to be hit until the pattern has confirmed with a breakout from this confirmation line. The cup with handle pattern, I actually have one that's going on right now on the TLT 20-year bond chart that I can show you. I can also tell you that that pattern is trying to bust and not do what it's supposed to do. The expectation of a cup and handle is a breakout from the handle. You've got this saucer shape or a rounded bottom that you'll get, and then you're going to see a declining trend off of that, and that's your cup with handle. The expectation is a breakout. I don't really have a minimum upside target for the pattern, but kind of what I eyeball and look for is the height of the cup and adding that to the back of the pattern. But that's just me. That's just from experience looking at it. That is not in any textbook you're going to find. So just wanted to make sure you knew that. The V bottom is an excellent pattern. These can be reversal or continuation patterns. You can see in this case, it's a continuation pattern. The V is continuing this move that we had going upward. So the V, you'll get these very sharp downturns and then kind of a sharp move to the upside. Once the once price has retraced 1/3 of the left side of the pattern. So if it travels up, let me get my pointer. So it'll travel up, and when it covers 1/3 of the left side, that pattern is confirmed. The expectation then is a breakout above the left side of the V. So you can see right here, we got that decline. We came up and we retraced 1/3 of this pattern on this side, and then we got the continuation of price moving up and breaking out above that left side. More water. Here we have a reverse head and shoulders. These are identified by a head right here, left shoulder, right shoulder. So you can see kind of a body shape here with the head and the left and right shoulders. This is a reverse of the head and shoulders pattern that is the bearish pattern. The reverse head and shoulders is a reversal pattern. You must come down into the pattern for it to be that pattern. A lot of people will identify these coming off of a rise, and that is not a correct pattern. It's not going to necessarily work out for you. The reverse head and shoulders are pretty good patterns, but not great patterns. I find that they don't make their upside targets that much. The upside target is also the height of the pattern, added to the neckline, which is where you have this shoulder end and the head start, and here where the head ends and the shoulder starts. So that's where these 2 points make your neckline. So the neckline isn't always going to be horizontal. It can be sloping upward or sloping downward. Either of them work. And so you add the height of this pattern to what we have here. That would put price right about in this area. We did eventually see it get to that area, but ultimately, and it pretty much started to bust. And busting this pattern, I believe it busts if you get a move above the head. So it's still a pattern. But really, when I start to see something like this, I just consider the pattern pretty much busted. So now we'll talk about the bearish chart patterns. And we have the descending or the symmetrical triangle. We have the rising wedge. We have a bear flag. You can imagine what that might look like. And we have the double and triple tops and the head and shoulders, which we just talked about, the reverse head and shoulders. And then there's a broadening pattern or a megaphone pattern that is also considered bearish. And then finally, the parabola or the parabolic advance. You'll see these a lot. And they work out pretty much every time. So that's a pattern you really need and want to know. I saved it for last because it's a very important pattern. So here's the descending triangle. Remember, with the ascending triangle, we had a flat top and rising bottoms. On the descending triangle, we have a flat bottom and declining tops. So in this case, you have that support line, you have price coming down into it, then you have price come back up, not make it all the way to the top because the bears start to win the battle, and then price will start to come right back down. It'll come back up, bears will win the battle, and a lot of times, again, you're not going to see it hit the it's just continuing in this declining trend as bears slowly win the race. And there's your confirmation. Excuse me, let's go back. There's the confirmation line, if you will, of the pattern. It confirms when you get the breakdown. So the idea is flat bottom, bears winning the game. Ascending triangle, flat top, bulls winning the game. And so the expectation here is a breakdown. These patterns, they can come, I would say they're not, I would say that they could be reversal or continuation patterns. You can see them at the top of a move, or you could see them come in at the bottom of a move. But typically, these are going to be a better reversal pattern than anything else. You're going to see them come in, you're going to see price come into them and up into them rather than price coming down into them. But you can have either way. The height of the pattern, the back of the pattern, is what I use to measure the minimum downside target of the pattern. So this was the minimum downside, and you can see the price did end up breaking down below that level. We have the rising wedge pattern, and this is also a bearish pattern. You've got a rising bottoms trend line, and then you have a rising trend line, rising tops, I guess, if you will. I don't like to say rising tops because we don't do rising top trend lines really. This is just putting it across the tops, but it turns out to be a rising tops line. You're going to see it's a wedge formation. You're not getting that flat top or the flat bottom to the pattern. So um, they will go up and start to form an apex, like a symmetrical triangle. Just takes a long time for them to get to the top of that apex. Typically, you're going to see the breakdown long before price gets up to the end of the pattern. These are reversal patterns, typically, because you're going up into the pattern and you're going to see a breakdown. But you can also see these happen as a reversal pattern where you get price coming down into the pattern and then the pattern reverses the pattern that you had before. So here is the rising bottoms trend line, and you can see the breakdown that occurred from this particular pattern. So this one is great to find too. These work out a lot of the time. I like the wedge pattern. The reverse flag or the bear flag, we talked about the bull flag. This is just the opposite. You have the long flagpole, and then you want to get your flag with rising bottoms. It's a rising trend channel off of the flagpole is better than a falling flag, or you could see the pennant on it. That symmetrical triangle could also be on the end of the flagpole, and that's perfectly normal, perfectly okay. Because remember, symmetrical triangles are continuation patterns. So price continues through the pennant or the symmetrical triangle on the flag. So here we had the height of the pattern. We took the minimum downside target. We can take the height of the pattern, subtract it from the bottom of the pattern. That tells you where to expect price to get to. In this case, it didn't get all the way down to that target, but that's sort of what you're looking for. Now, all of these patterns, I haven't been talking about setting the stops too much here, but really most of these patterns, you can probably imagine where you want to set up a stop. So for example, in this pattern, we had the reverse flag. The expectation is that you're going to continue to see price move down this way. So this would be a short that you'd be looking at. So where would you set your stop? Well, in this case, the drop here was 6.1%. That's about right for me as far as my stop levels go. So I would have my stop, my upside stop in this case, set at the bottom of this flagpole. If you needed a really tighter stop, you could look at it in terms of the flag itself and set your stop a few tick marks above the top of the flag or the symmetrical triangle. All right, the bearish double top. These you're going to find on a lot of patterns. You might recognize this chart. We looked at it for the double bottoms. So here you can see there's the one double bottom over there, and there's the second double bottom over here. And interestingly, we ended up coming up and out of this double bottom right into a double top pattern. You're going to see two tops that are typically right next to each other, very similar in height. If they're really off on their height, it's really not a double top. You can still expect the downside move, but because depending on how that pattern forms, you could end up with a descending triangle, right? You could end up with declining tops and a flat bottom. So that would be something to look for. But this is the double top. You take the height of the pattern and subtract it from the confirmation line, which is what that red line is right there. And there you have the downside expectation, the minimum downside target for the pattern. And in this case, it was a minimum downside target because price fell even further and dropped down into the reversal double bottom pattern. And as far as setting stop with this, we're talking shorts again in this case. Now my mouse is acting up. Just one of those mornings. So you could set your stops. Again, you're looking at a short. So you've got the pattern set up here. The measurement, you could set it up where the pattern will bust. A bearish double top will bust if price gets above the tops. So you can set your stop above the tops on the bearish double top. The bearish double bottom, you can set it below the double bottom right here. So you have the two bottoms. You could set it below where the pattern is going to bust. Now, of course, if the height of the pattern is longer than your stop level, then you're going to have to work it out on your own. But typically, you're going to see the pattern and the height of the pattern. You're going to get your downside target. You're going to look at your upside target from as far as the double top pattern. You're going to look for that upside target right around the tops as far as your stop on a short. Whereas with the double bottom, you've got your pattern, you know where you want to see price go to. The pattern busts if price goes below those bottoms. And so that's where you're going to want to set your stop. The triple top, and I don't think I showed you a triple bottom. These are really unusual patterns. They don't happen that often. I mean, I've been studying the market for years, and I can only think of a handful of triple top patterns that I've seen. And mainly because the textbook formation is that all these tops need to be pretty much in line. And that's hard to get. That's very hard to get. So in this case, though, this is a perfect triple top. I'm amazed I found it. And you can see basically, unlike the double top, you have three tops for the triple top. The confirmation line would be down here at the bottom of the pattern. And again, this is one you can calculate your downside target for. So we take the height of the pattern, subtract it from the bottom, the confirmation line of the pattern, and that tells you where to expect price to go to. And in this case, the pattern did fulfill. Here is the ever famous head and shoulders pattern. There's your head, there's your left shoulder, and your right shoulder. Price will oftentimes form these patterns, and it is sort of a rounded top, which is another pattern that I like to look for. I don't consider it a chart pattern, but it's something we all can look for: rounded bottoms, rounded tops. And so the expectation of the pattern obviously is a breakdown. The volume should typically be higher on the left side than on the right side. And that's something that's a good thing to check out. It is a reversal pattern. This head and shoulders will only show up at the top of a move. So don't be looking at a head and shoulders if price is coming down into it. It's not a head and shoulders pattern. These are only reversal patterns. The double top is also only a reversal pattern. The double bottom, also only a reversal pattern. So those are the main ones that you want to pay attention to and make sure they're coming at the right point in the chart. So here we have the left shoulder head, right shoulder neckline. This is where the shoulders kind of connect to the head. Sometimes these head and shoulders can be a little messy. And so you might pick a point over on this side of the pattern rather than the point over here, which is in between the left shoulder and the head. Sometimes these patterns get a little messy, and it can be a little harder to determine the neckline. Just remember, it's right where the head and the right shoulder connect. That's where you're looking to form your neckline. Because unlike that reverse head and shoulders, like I said, the necklines can be rising or falling. Typically, I like the ones on a head and shoulders, the neckline to be rising. So we take the height of the pattern, subtract it from the neckline, and this was the minimum downside target of that pattern. I was unable to find a pattern at the time that fulfilled that promise on the downside target. And that's because these patterns, while they're very famous, I find they just don't work out that often. They do give you the breakdown. I almost always will see the breakdown, but you're not necessarily going to get to that downside target. We have the broadening pattern or the megaphone pattern. And this is determined by, you can see it's shaped by a megaphone. So these lines are not parallel. They're one's moving higher, one is moving lower, and it's broadening. The pattern just gets more and more broad as you go along. These are considered bearish patterns, so typically you're going to get a breakdown eventually from these patterns. In this case, it looks like we might have been getting a breakout coming, but you can see that price was starting to head back down. And the reason that these are considered bearish patterns typically is because price is getting more and more volatile as we move down into the pattern. And typically volatility is not going to be your friend. And so that's why these patterns are considered bearish. I don't see these patterns that often, but they're out there. This is the parabolic. Look at this chart very carefully while I drink some water. It's very important that you understand the parabolic pattern. This chart is a chart of Apple. So you're going to see this on a lot of the like the AI darlings, basically anything that just starts taking off. And you need to pay attention to it. It's basically your rally that you're getting into. You'll start to see steeper and steeper rising bottoms trend lines. So you can see here it was steep, then it got steeper, and then it got steeper, and then eventually it was moving straight up in the air, vertical. They're going to fail. We've seen a lot of the Magnificent Seven pull back into correction territory over the last couple of weeks. And you'll note a lot of these have gone into these sort of parabolic moves to the upside. I would say a great example of a parabolic move right now is gold. Gold is starting to go parabolic and get its rally rather vertical. So we should look for some kind of a breakdown. Another great example of a parabolic, and it looks like we may have time to go and look at it, is Bitcoin. Bitcoin has a parabolic formation. These patterns, like I said, will always break down, and it's usually swift and painful. So you don't always get a 39% decline out of a parabolic, but you're certainly going to see some high-level consolidation at best before you get the rise back up. So you can see right here, it got very vertical. We started getting some high-level consolidation out of it rather than the big breakdown. But I believe we ended up with a pretty good breakdown at that point, but I can't be certain. So setting up your stops using the chart patterns, you have to recognize the pattern first of all. That's going to help you figure that out. You want to look at those pattern measurements. That's going to tell you the height of the pattern, your expectations. So you can look and see where the breakdown could occur on, for example, those double bottoms. We got the height of the pattern. But the bottom of that pattern is where you're going to want to set that stop below those bottoms, because that means that the pattern would be busted. You can look at minimum downside targets, and that's also helpful to set up your stops and determine where you want to set your targets, of course. You can set your stops and targets using those measurements. I look for nearby support and resistance, and half the height of the pattern is one of the things that I look at. Let me see. I don't have a good example of that. I apologize. I will talk to you. We're going to go look at some patterns. Hopefully, we can find some patterns, and we'll do some chart analysis since I did run out of time here. But I did want to tell you about my free decision point trading room. I hold these on Mondays between noon and 1 Eastern time. They are free. You can get to sign up through signing up for my free newsletter, or there's a registration link right on my homepage that I will show you. Let me see if I can get to. Right. Give me a moment as I get my share here changed. I want to make sure I'm on a good page for us here. Okay, what's going on? I'm telling you, the technical difficulties today have been just terrible. Now I can't get my, let's see. All right, it looks like amazingly, I'm shocked to say it, but it looks like stockcharts.com might be having some problems. So let me go to my website and I can show you some stuff through the website. Okay, good. So I know at least we're talking here. Okay, let me do a new share. All right, so we can talk a little
Stock
bit
charts
about
is
my,
not it's not loading right for me either, so it's not just you.
okay, good. All right, so can you see this right now? It should be Safari or Chrome, my
Yeah,
website.
yeah, I can see it.
Okay, good. All right. There we go. So yeah, I don't know what's going on with stock charts, but we'll have to go back and hopefully we'll see some charts there. But I do have a couple I can show you through my website. So this is decisionpoint.com. I do have two newsletters that I do, the Decision Point Alert and Decision Point Diamonds. Actually, what I might do is walk you through our Decision Point Alert. And you can see what we're thinking about the market right now. Um, Decision Point Alert gives you the trend and condition of the market in general. And then it does cover Bitcoin and crude oil, dollar, gold, yields, bonds, gold miners. It covers all the major areas of the market. So you can read this every day. It's an executive summary, so it doesn't take you forever to get through. It's very easy to understand. And you're basically set up to make your trades that day when you read it in the morning. We publish it at night. Decision Point Diamonds also goes out in the evenings after the market is closed. I give you 10 stock and ETF picks per week that you can use and hopefully make some money on. So those are my two products that I do have, but I also have the Decision Point scan alert system, and this is brand new. This will give you the results of my premium scans, the exclusive scans that I came up with that I use to determine Decision Point diamonds. So this gives you kind of the raw data of what I take and determine and pick my 10 stock and ETF picks from. So that's a great way to get good symbols delivered in your email box every market day. So let's see. I was going to show you where to register for my newsletter right here. Sign up. Some of you I may end up getting, but not all of you. So if you're interested in what I've talked about today, I would love for you to sign up for my free newsletter. I send very little. I send maybe once a week articles, sometimes twice a week. And then you'll get the periodic invitation to go to presentations like I'm doing today. This is where you will register to go to my free trading room on Mondays at noon. We have a great time in that trading room. We go through the market in general, and then we go and do about a half hour of straight symbol requests from those of you in the audience. All right, so let's go and see. Let's see if stock charts is working right now. Okay, it's up. But you know, I think I want to walk you through, I want to show you two charts for definitely before we go today. Let's go to Bitcoin. Here's an example of a parabolic move. Here you have the rising trend gets steeper and steeper and steeper until we end up with a vertical move. And then you get the parabolic breakdown, which is exactly what we got. We ended up with high level consolidation, but you also know it was a very painful decline as part of that. We went vertical, so we're even more parabolic currently here. And then we formed a double top. You can see top one, top two. You can see it right here on the Bitcoin chart. Top one, top two. And we got the breakdown from this confirmation line. And it came down to just about really, it pretty much hit the downside target of the pattern from there. So that was one I wanted to show you. And then I want to show you TLT. Oh, shoot, do I not have the right one? Don't have the right chart. Well, we'll annotate it for you right now. Can you spot on this chart? Can you spot the cup with handle? Let's find the cup. And where is the handle? It's kind of obvious now, right? So we had the breakout from the pattern as expected, but it got nowhere near what I would call an upside target of the pattern. I would use the height of the pattern again to look for where your upside target would be. This is my own determination. It's not in the textbooks to use the height of the pattern of a cup and handle. But again, I think it's a really good way to get a sense of where to expect price. It's maybe won't reach that price, but it's certainly something to look for. So you can see we have quite the height of the pattern here. And so the expectation would be a move back up well above 97 if we could get that. But I'm not expecting the pattern to work out now because we are seeing this breakdown. But at the same time, if we see it kind of consolidate a little bit here, then I would say that would be the handle of the pattern. But right now it's not confirming, whereas the Bitcoin one definitely was. All right, let's get back here. So I talked to you about my subscriptions. I am running a 2-week trial. So you can get 2 weeks for free of any of our reports by using the coupon code DP trial and the number 2. I will put that in the chat right now. DP trial 2 is the coupon code to get 2 free weeks of Decision Point subscriptions. There we go. It is now in there. And I do see there is a question whether I trade options or just stocks. I am just one to trade options. No, I don't trade options. I do stocks. I'm sorry. I'm reading and see if there were more questions. No, I don't do options. That's just not my thing. I do stocks. So, but you can still use the chart patterns to determine and find those opportunities for your options as well. So I just wanted to walk you through my DP alert really quickly. This gives you a really good idea of what I'm talking about and what we do. So I usually have a lead. One of the things you're going to find with a lot of our charts is that we do what we call under the hood indicators. So it does look like a lot, but it's not too bad here. I have a presentation that I do on participation indicators, and I'm doing part of that coming up next week. So if you do sign up for my free email list, you'll get opportunity to go to that presentation. So I was looking at the fact that, small caps were doing very well. Yesterday, they finished higher than any of the other indexes that we follow. Looks like we're getting a little bit of a continuation today. We have our signal tables. So the intermediate term trend model determines if the 20-day EMA is above the 50-day EMA. The long-term trend model gives you the golden cross, 50, 200-day EMA. That's a buy signal, a golden cross buy. But there we have the 10-minute bar chart. I go through the daily chart of the SPY. At this point, we're looking at a possible double top that fulfilled. And now what do you see? That looks like a lot like a reverse flag. So we're very concerned right now that what we're seeing is a bear market rally and not the beginning of something big. I wouldn't throw caution to the wind just yet because of that pattern. Here's the recording to our video. We have